Hello and welcome to another episode of Darwin Investors. Man, this is a huge week for the market this week, aren't they all? But for me, this one's actually particularly big because this is a FOMC meeting week. And we're going to get a chance to see when Jerome Powell speaks to the press on Wednesday whether or not the Fed has woken up and recognized that the data that they're looking at is outdated and maybe they should adjust accordingly and soften up a bit, or if they're just going to stay the course that they're on and just continue over tightening until we're in a nasty recession. And based on what they say this Wednesday, I'm going to be making some pretty big portfolio decisions for myself. I just don't know what I'm going to do yet until I hear them speak. Now, the data, like I said, that they're looking at is really outdated, and usually that's not a problem because things don't change that fast. But right now, things are changing really fast. We got companies that report earnings and guidance, and then a month later, they have a revision saying, sorry about that, we're going to be making a lot less money. We've got housing prices that are falling at some of the fastest rates in history. We've got Amazon that just reported their earnings and their guidance, which was weaker than expected, causing a stock that was already down 30% for the year to crash even further. And normally, from a lot of companies, say if it was like a Snapchat or something like that, it's not that big a deal. But to me, Amazon's kind of a bellwether for the U.S. economy and the U.S. consumer in particular. And so if like the economy is like the patient, Amazon's kind of the heart, and the heart's not doing so well right now. I wonder if the Fed's going to pick up on that. So what do we do now as investors? Well, I'll tell you what I'm going to be doing. If I pulled everything out right this second, I'd still be up 10% from when I started this version of my investing journey where I'm kind of like actively trading stuff. And I'd be up 10% right now, and I'd be like, all right, well, I did all right. But that's not what I'm going to be doing because I like this too much. What I'm going to be doing is kind of my own modified version of a 60-40 portfolio, where the 40% that's usually bonds, I'm actually going to make that JEPI, and that's going to be actually my bond portfolio is going to be JEPI. And then the other 60%, that's what I'm waiting on the Fed decision for. I don't know, depending on what they say, I might try to ride the energy wave with that 60%. I might try to invest it into some of these really badly beaten down consumer staple stocks that are tech related, like a Microsoft or an Amazon or a Google. Or maybe I'll invest 50% JEPI and then I'll use the remaining 50% of cash as collateral to just like sell put options and just continue trying to make money that way until the Fed wakes up. Either way, I'll be putting money into JEPI, and I'll be letting you know later on in this video. But first, before we get started, I need to give a quick shout out to my sponsor. Guys, have you ever wanted to get a lower back tattoo of Warren Buffett's face and you just didn't have the guts? Well, don't worry. Look no further than my sponsor this week, which is beer. I think I'll get Charlie Munger too. And actually, this beer is very delicious. It's Iron Maiden's Trooper beer. It's very hard to find in this area, and I do love its delicious flavor. And I give this beer 5 Kate Rooneys out of 5. Now let's go ahead and get started. So the U.S. Bureau of Labor Statistics is going to be releasing their latest CPI data on November 10th at 8:30 a.m. And what it's projected to show is that the year-over-year inflation is going to be 8.1%. Last month it was 8.2%. And people are going to think this is very, very high, and it should send the market into a bit of a tailspin as people begin to think that the Fed's going to have to tighten even more. So with this 8.1%, I already did the math. And in order to get it to 8.1% down from 8.2% year over year, this number will have to increase from 0.4 to 0.75, or probably they'll just round it up to 0.8. Now, what would make this number so large? Well, one is this month over month energy data. This might actually become positive numbers, something probably closer to May here, 3.9, 4.5, because we're doing month over month. And the other one that's going to cause this, and probably the bigger one, is going to be shelter, because this is 42% of all inflation. It's overweight shelter. Shelter is a lagging indicator, and it's interesting to see if they're actually going to pay attention to current real estate trends, or if they're going to just go straight off of this number. I don't know which they're going to do, but I think we all know that real estate is coming down in price. That the cost of our home now, if we try to sell it now, we're not going to get as much money for it now as we did, say, 5 or 6 months ago. We know that this number should be coming down. However, it continues to go up. And also, that interestingly, is that rents continue to come down. And this is important because it really shows that the strength of the housing market is really bad. It's so bad that there's such an oversupply and no one can sell, that people are undercutting each other just to rent. Like, look, I can't sell this. I'm an investor. I bought 200 homes. Now I have to try and rent these homes out or really lose a lot of money. And another builder might say, well, I have to rent my out and lose money, but I got to undercut you. And that's how rents fall, is that there's just too much supply and everybody's undercutting each other to at least get somebody in the door. And this is happening all over America. It's and on the higher end here, like in New York and San Francisco and San Jose. This is 1-bedroom prices and 2-bedroom prices for apartments. We can see that month over month, for both types of residences, that the rents are actually coming down. You would expect that here on the higher end, a place like San Jose, maybe a place like San Diego. You would expect that these prices would be coming down month over month. But also on the lower end here of rents, you can see that month over month things are coming down. When we look at places like Wichita, Kansas, or say El Paso, Texas, Oklahoma City, Omaha, and the like. So on both ends of the spectrum, the price of rents are coming down. And that's bad because that means that there's an oversupply of houses and then the price of houses are coming down. Nevertheless, this data is going to show that the price of houses are going up. I'm just wondering what the Fed is going to do with this data. And that's another reason why I'm really interested in what they're going to say this Wednesday. Now, switching gears here, what do we do with this information when we get it here this Wednesday? And a place to usually hide out, at least it was a safe place for retirees and that sort of thing, would have been in the 60-40 portfolio. And we're finding that the 60-40 portfolio is having one of the worst years ever on record. Now, this person probably sells 60-40 portfolios, this Mark Hulbert. So he is painting it in kind of a rosy scenario. He's saying, hey, this is not the worst year in U.S. history for a balanced 60-40 stock to bond portfolio. He's saying that there's no doubt that it's bad. Your year-to-date loss through September 15th would be 20.4% if your portfolio allocated 60% to the Vanguard Total Stock Market Index Fund and 40% to the Vanguard Long Investment Grade Fund. So this would be probably investment grade corporate bonds. And so these are a couple of good stocks to probably look at if you're looking at getting into a 60-40 portfolio. For the full year 2021, in contrast, the portfolio would have gained 14.4%, and in 2020, it would have gained 18.7%. This year, we're down 20.4%. And what he's saying is, to determine which was the worst year, they took a historical database dating all the way back to 1793. That was a tough year. So the worst 12-month period for a balanced portfolio was from January 1931 to January 1932. And in that year, the portfolio lost 36.3%. The next worst occurred over the 12 months through January 1842, also another difficult year if memory serves. And in that year, the portfolio lost 27.1%. In third place, we'd have to go back near the Great Depression when it lost 24.5%. Now, if the 60-40 portfolio stayed flat for the rest of the year, it wouldn't be the worst. It would only be the fifth worst in 1793. Now, this is how I know this guy sells these things, because it's not good, but it's not the worst, But no, fifth worst is still pretty bad going back to 1793. So here's another chart looking at, the 5 worst years for U.S. stocks and bonds, 60-40 in the last 100 years. And it would show that in the last 100 years that this would actually be the third worst, actually worse than the 2008 great financial crisis. And the reason why that is because if you look at this chart here, this is the only year that I can see, and this one only dates back to 1980, where both assets. So the stocks would be the green, and then the fixed income would be this color here, whatever that is, like a darker green, I guess. But it's the only year where both your stocks and your bonds were negative. If you look over here, the stocks were positive, bonds negative, stocks and bonds positive. But this one here, we had the stocks go positive and bonds go negative. But this is the only year on this chart where stocks are negative, bonds are negative. And maybe that's where people are getting at. As a matter of fact, this is the only year ever in the history of the stock market, even back to 1793, where both stocks and bonds were down over 10%. So when we look at this very popular ETF called the TLT, and what this is the 20-year Treasury bond ETF, and we look at it year to date, we can see that this one, if you put your money into bonds, you would be down 32.92% on this. And over the course of a year, you'd be down 33.9%. And this is an analog for the 20-year Treasury bond. Over the course of 5 years, you would be down 22.95%. I would argue that the 60/40 bond portfolio is not just dead now, it's been dead for a very long time. You've also got the IEF. It does the 7 to 10 year Treasury bond. Year to date, this one's down 16.76%. Over the course of a year, it's down 17.2%. And over 5 years, it's down 10.8%. Over here, we've got the SHY, it's the 1 to 3 year Treasury bond. Year to date, this one's only down 5%. Over the course of a year, it's down 5.45%, and over 5 years, it's only down 3.64%. Perhaps if you really want to go into bonds, this might be your best bet to be down the least. The S&P 500 year to date is down 18.67%. Over the past year, it's down 15.45%. Now, if you just shun bonds altogether, over the last 5 years, you'd be up 50.75%. So I would say that the 60/40 portfolio is not just dead this year, it's probably been dead for quite a while. But this year, it does seem like there's a reemergence where people are starting to talk more and more about bonds, and maybe they are a good investment right now, and maybe they aren't. I don't know, only time will tell. But my direction is I'm going to be going into this JEPI dividend fund. And JEPI is interested. Now, if you look at this one here year to date, it's also down. It's down 13.16%. However, it pays an 11% dividend. So if you've got an 11% dividend and over the year you're down 11%, at least you're getting all your money back. And what everyone could just agree is a very rough time. Now, how does it pay a dividend like this? And what makes it such a fantastic substitute for bonds? Why not just put it all into the S&P 500? Well, I mean, a lot of people think 2023 is going to be a really rough year, myself included. If the Fed continues down this path and they're not looking forward or even using the data that's current, if they look in the world around them, if they continue to just tighten and shove this economy into a nasty depression, well, then this is not a bad place to be, and I'll show you why. Because JEPI's holdings are very, very conservative. You can see that what they're doing is what we should be doing, but a lot of us don't have the guts to do. And we can see that they put a lot of money into healthcare stocks, consumer staples, Exxon, and this portfolio is actively managed by JP Morgan investors. And a lot of these stocks you can see of the holdings are up year to date. You got AbbVie's up 9%, United Health is up 9.7%, Hershey's up 24%, Exxon 80%, and so on and so on. Now, their dividend right now is 11%. This is annualized, so you get a portion of that every month. The dividend is paid out monthly. We can see that for every share, you get 48 cents this month, 56 cents, 50 cents that month, 62 cents in July. And this is all based on the fact that this is a covered call ETF. And so if you look at a lot of the holdings here in JEPI, you'll notice that they do a lot of covered calls on the S&P 500. Now, the covered calls pay a bigger premium when the VIX is really high. And if you look at the VIX this year, I mean, a low time for the VIX might be at 20. If you look at the VIX, say over here or over the maximum, you would see that 20 is actually kind of a high point. So right now, our low is what is a traditional high for the market. And so what that means is volatility is very high. When volatility is very high, then the premiums that you get for selling covered calls is also very high. So they've got a very conservative stock portfolio, and they've also got covered calls that are essentially shorting the S&P 500 during a time of very high volatility. For these reasons, this company pays a very nice dividend of 11%. Now, if the stock market was to go up, you pull your money out of this, you put it into something else, because this distribution yield logically will come down as the VIX comes down. This might get down to 7 or 8%. But right now it's paying 11%. It's giving you a defensive portfolio, and it's shorting the market in a time when a lot of us believe that the market is going to be going down. Now, instead of just buying this ETF, could you not just go ahead and look at their largest holdings and just buy these stocks, hold them in your portfolios, and then sell covered calls on these stocks yourself as a way of shorting the market? Sure, that's an idea. Maybe the Fed's going to show that they're going to be softening up a bit. Maybe you want to go into some stocks that are really beaten down and kind of take that approach. Buy this one just in case things don't go up, and have something like a Google and a Microsoft and an Amazon just in case things do go up, just so that you don't miss the surge upwards. That's an idea. You might just ride the energy trade, as a lot of people think that those stocks are going to go up. That's an idea. You could just sit here and you could ask Darth Vader what he thinks. Darth, should I just buy 100% JEPI? I don't know.
It is the only way.
Wow, he said it's the only way. Are you sure about that?
Search your feelings, you know it to be true.
Huh. Apparently, according to Darth Vader, I should just do 100% JEPI, but I'm not so sure I'll do that. I'll just go ahead and probably just at most do 50% of this, and then sell options on it or something like that with the cash. So I do plan on running a portfolio. It's going to be pretty heavy in JEPI, and I'm going to choose one scenario of where I'm going to go forward depending on what direction the Fed decides they want to go in. So if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until the next time, we'll see you. Have a good day. Bye.
Not really. Yeah, sorry. I'm kind of dead today. But anyway,
last night was karaoke, and we were out way too late, and that's why I'm sober. That sucks.
So thank you for joining us on our brew day today, and I just wanted to say, to bring it back around, that Iron Maiden, phenomenal band, phenomenal beer, made by Robinson's Brewery. English ale because it's delicious.
In paying homage to English ale and Iron Maiden Trooper beer, we will close out, as Beer No Evil always does with rockin', to Iron Maiden, the Trooper.